Have you ever heard of a 2-1 buy down or just a temporary buy down in general? Most people hear 2-1 buy down and assume it's some kind of complex financial trickery. In fact, I recently had a client that was getting a 2-1 buy down and a friend told them, oh, you don't want to do that. It's a waste of money. There's better things to use seller concessions on. But later that same day, the friend called him back and said, oh, actually I did some digging and it looks like these are pretty common and they do make a lot of sense. But at the end of the day, it really just depends on your situation and what's most important to you as the buyer. Before you even get there, you have to make sure you understand what a buy down is so you can determine if it makes sense for you. So I want to walk through what these buy downs are, how they actually work, where the money comes from, and when they make sense versus when they don't. At a high level, a temporary or temp buy down is pretty simple. You or somebody else is just prepaying interest to the lender in exchange for a lower monthly payment during the first 1 to 3 years of the loan. That's it. Nothing's being discounted permanently. Nothing is being waived or anything like that. It's just structured differently so that you're coming out of pocket less during the first year to 3 of the loan. Now this is true for a temporary or temp buy down. You can also do a permanent buy down, but that's a topic for another video. When it comes to the temp buy down, there's a few different types, such as the 1-0 buy down, the 3-2-1 buy down, or the 2-1, which is the most common and the one we'll use for examples in this video. So here's exactly how a 2-1 buy down works. In year 1, your interest rate is actually 2% lower than the note rate on your loan. In year 2, it's 1% lower than the note rate, and starting in year 3, you actually enter that full note rate for the rest of the loan. So if your note rate or your interest rate is 6.5%, in year 1 you'd pay 4.5%, in year 2 you'd pay 5.5%, and in year 3 through 30 you pay 6.5%. So the part most people don't see is how that payment reduction actually happens. Because the lender isn't just giving you a lower payment, the difference in your payment is being covered by money that's already set aside when the loan closes. So at closing, a lump sum is deposited into what's essentially a buy down account or an escrow buy down account. And then each month, that account makes up the difference between your reduced payment and the actual full payment that the lender is expecting. So from your perspective, the payment is lower, but behind the scenes, what's happening is that that account is subsidizing the difference. Now, where does that money come from? Most of the time, it comes from seller concessions. So money the seller of the property agrees to provide out of the proceeds from the sale. So instead of lowering the purchase price, a seller might contribute money towards closing costs, and that money can be used for the buy down. Sometimes this is more advantageous from the buyer's perspective. And you'll also see this with builders or sometimes lender credits in certain scenarios. And depending on the lender and structure, borrowers can also sometimes contribute to these buy downs as well or just pay for them outright. Now, there's not always a clean label for this, but you'll generally see 2 variations on how these are structured. One where the buy downs can be paid by numerous sources or individuals, and one that's only able to be paid by seller concessions. And in that case, the entire thing has to be paid by seller concessions. Now, sometimes these are priced differently, so one's more advantageous than another. So why would somebody do this though? Well, there's a couple really common reasons, and the first one is very basic. It's just lowering the monthly payment in those early years. So if someone is, like, let's say transitioning jobs or moving, or they just want some breathing room up front, that can really help kind of smooth out that adjustment. And another reason would be strategic use of concessions. So if a seller is offering credits anyway, using that money to reduce the monthly payment for a couple years can be really impactful. And then in some cases, people just like the idea of easing into a full payment instead of taking it all at once. One big reason that people opt in for these temp buy downs, and one I don't endorse, but it's that people expect interest rates will drop in the coming years. So they think, I'll take the 2-1 buy down now, have a lower payment for the next 2 to 3 years, and by the time year 3 rolls around, interest rates will have come down and I'll just refinance. Now, if the stars align, that's a great plan, but I wouldn't build my life around that. No one knows what interest rates will do in the future, so just proceed carefully. Now, where these buy downs get interesting is how they're used. So a buy down works best when it's part of a plan. So it's a short-term structure It makes sense if you know your income is changing, let's say, or maybe your seasonal income, or you're intentionally creating flexibility in the first couple of years. But it's important to evaluate how you're using your seller concessions. This is where the plan comes in, because it may make more sense for you to do a temp buy down, or it could make more sense to just have the seller concessions pay most or all of your closing costs. Now, in some cases, you can do both. That's the ideal. But these nuanced questions are really why it's so important to have a good loan originator that you can talk through these situations about, someone that understands the ins and outs. So if you end up going with a temp buy down, just be sure to remember that the breathing room in your monthly payment is not permanent. The lender and underwriter, they're going to qualify you for this loan based on the full note payment. So the mortgage payment that you'll be responsible for from years 3 to 30 in the case of a 2-1 buy down. But as I've discussed in my other videos, what the lender will qualify you for and what actually makes sense for your life are not the same thing. So the question with these temp buy downs isn't whether or not they're good or bad, they're just a tool. That's all they are. So the question is really, does it fit your situation and does it help you achieve your goals? Is it better for you to have the flexibility that comes from a lower payment in year 1 or 2, or is it better to keep that cash in your pocket and have someone pay your closing costs? That's really what it comes down to. There's no right answer, just one that makes the most sense for you. Now, if you're trying to think through all of this and you want to look at your numbers in a way that actually feels clear and not pressured, that's exactly the kind of conversations that I have with people. So if you're feeling stuck or just want a second set of eyes on it, you can schedule a call with me using the link in the description below. We'll walk through your options and just kind of help you make a decision that actually holds up long-term for you. But appreciate you guys for hanging in there. Please be sure to like and subscribe, and I'll see you next time.